Oracle stock just dropped more than 12% in a single day. Not because demand is weak, not because customers disappeared, but because investors are suddenly asking a much more dangerous question. Are these massive AI orders actually real money? Or just promises that may never get paid? In this video, I'll break down Oracle's earnings, explain why Wall Street is worried, and tell you whether this drop is a buying opportunity or a warning sign. After Oracle reported its latest quarterly results, the market reacted fast and brutally. The stock sold off hard, and the reaction surprised many investors because on the surface, the numbers didn't look terrible. Revenue was up, orders were up, cash flow increased. So why did the stock fall? Because the market isn't focused on growth, it's focused on risk. And that risk comes from how Oracle is funding its AI expansion. Oracle reported total remaining performance obligations, or RPO, of $523 billion. That number is massive. It's up 438% year over year. Earlier this year, increases in RPO were pushing Oracle stock higher. Investors loved the story. But now, sentiment has flipped. Wall Street is asking three uncomfortable questions. First, who are these orders coming from? Second, will those customers actually have the cash to pay? Third, how much margin is Oracle giving up to win these deals? If Oracle had to offer aggressive pricing to secure contracts, future profitability could be lower than investors expected. Oracle highlighted new commitments from companies like Meta Platforms and NVIDIA. Noticeably missing from the spotlight was OpenAI, and that wasn't an accident. OpenAI is signing contracts worth tens or even hundreds of billions of dollars. But OpenAI is also losing billions every year. The concern is simple. Where does the money come from? Large language models cost enormous amounts of computing power. Every ChatGPT question burns real. If OpenAI ever starts charging users more aggressively, how many leave? If adoption slows, can these contracts still be honored? Those unanswered questions are making investors nervous, not just about Oracle, but about the entire AI infrastructure trade. Quarterly revenue increased 14% to $16 billion. Operating income rose from $4.2 billion to $4.7 billion. That's solid. Even better, Oracle reduced sales and marketing spending while revenue grew. That signals real organic demand. Operating cash flow over the last 12 months reached $22.3 billion, up 10%. So what's the problem? Capital expenditures exploded. Over 6 months, CapEx more than tripled from $6.3 billion to $20.5 billion. Oracle is spending far more cash than it's generating. That's the pressure point. Oracle's cash balance rose to $19.2 billion, but it came from borrowing. Total debt climbed from $85.3 billion to nearly $100 billion, and it's likely going higher. Property, plant, and equipment investments jumped 50% in just a few months. These are high-quality AI infrastructure assets, but they are expensive. The difference between Oracle and past failures like Intel is critical. Oracle already has demand. Intel built capacity hoping demand would follow. That lowers risk, but it doesn't remove it. Oracle pays about $5.7 billion per year in dividends. Right now, free cash flow is deeply negative because of CapEx. If borrowing becomes too expensive, management may have to choose between more debt, issuing shares, or pausing the dividend. A dividend pause would protect the balance sheet, but it would shock income-focused investors. This isn't imminent, but it is now on the table. After updating my valuation model, Oracle's intrinsic value dropped by about $20 to $30, landing near $221 per share. With the stock trading around $196, it appears slightly undervalued. Forward valuation metrics support that. Forward PE around 27, forward price to operating cash flow around 23. I am maintaining a buy rating. But this is not a low-risk buy. Oracle is telling investors clearly, it will spend more money to generate the same revenue in the near term. Cash flow risk is the story right now. The reward is real. The demand is real. But the financing risk is also real. If Oracle executes, today's drop could look like an opportunity. If AI monetization disappoints, this stock will remain volatile. That's the trade-off.